My name is Afsaneh Beschloss, and I'm so delighted to be with this incredible panel. We're going to compete with the previous panel and be much more fun and interesting and important. I have three speakers with me today, and they have incredible experience in the whole energy transition area for many, many years in many ways, as you will hear from them. Bob Markin here on my left is Deputy Director of the U.S. Department of Energy's loan programs. He's going to tell you the scale of the LPO office. And he has been working closely with his colleague Jigar Shah, who serves as key advisor and point of contact, or LPO, to other federal agencies and organizations. As we all know, working closely with people at the White House, people in Treasury, people across the board on all matters related to the program. What is really important also is that Rob has spent over 25 years in broadly power, but also areas related to energy, including and he'll tell you he's been at Aramco, where he worked in Saudi Arabia, and he's been working in project and corporate finance across different areas related generally about energy and power. So he's been doing this for a long time, and when you hear from him about the scale of what he does, it blew my mind. Jeff Ross also is Chief Investment Officer of Infrastructure at Generate Capital, one of the largest, very successful companies in the energy transition area. You were very early. Generate was one of the earliest investors and has been very innovative in the way that they have invested in the climate transition. And it's not just the scale, but also they've been thinking about the future of the industry and how do they structure a new kind of company for the future. And very delighted, Jeff, to have you here. And by way of, I should also say that we invest with Jeff and his team, so very, very excited and great returns. And finally, on my right is also Justin Heyman. Justin is Managing Director at RockCreek, and he leads our Smart Futures team, investing directly in energy transition. Only made 10 investments last year, and hopefully you'll mention a few of them. CEOs of Delta Airlines, Exelon, and other CEOs talk to Justin for advice and for getting an idea about how they should be looking at their industries. And I think that gives him a lot of insight into what companies are going to succeed or not. And that has impacted his investment. But I should also mention he worked at the Global Environment Fund, which was one of the early funds investing in this area. A little known tidbit is another one of his colleagues there was somebody called Jay Powell for a short time. So that's not generally known. And he was also managing director and co-lead there of their U.S. growth program. So this is a fabulous panel we've got. What I thought I would ask is, if it's okay, very, very briefly to say what you're doing to each of our three panelists to start with, and where in the whole energy transition area specifically, which part of the stack are you investing in? So maybe we'll start with you.
Yes, and thank you very much. I'm very happy to be here today and pleased to speak with you. And as Afsaneh said, my name is Bob Markham. I'm Deputy Director of the Loan Programs Office. At the Loan Programs Office, it's a U.S. funding office similar to Exim Bank, OPIC, DFC, and we have a significant amount of funding under the Inflation Reduction Act to support, we say that it's private sector-led, government-enabled. So private sector who are willing to take the risk on innovative technology and new plants and processes that support greenhouse gas reductions in the United States. We provide senior debt financing. We're organized by Congress. We're organized by a bipartisan act of Congress in 2005, which was signed into law by George W. Bush at the time. And we are specifically by statute required to be senior debt. It's come down from on high, meaning Congress, that we're never to utter the word subordinated, so we won't. And but as we participate mostly in project finance structures. In the project financing, we're senior secured debt. We can lend with other lenders, so we can have co-lenders, we can be pari passu, senior secured debt. We can also have subordinated debt or mezzanine, tax equity. We can accommodate any types of finance structures. And then we also do a good bit of structured corporate finance where we are senior lender in the cases where there's a large scale investment grade entity that doesn't offer secured debt. We can be senior unsecured, but we're always going to be a senior position in the capital stack. And as I said, supporting innovative technology and manufacturing in the US. And we have, under the IRA, we absolutely got turbocharged. We have $350 billion of lending authority that we're currently implementing. Right now we have over 200 loan applications for over 260 applications for over $200 billion of loans requested.
Wow. Jeff, it would be great to hear from you.
Yes, and first I'd like to thank you for having me here and thank you for all the support that you and RockCreek have provided to Generate. RockCreek's been a tremendous partner to us. We really appreciate it. Generate was founded about 10 years ago by three entrepreneurial co-founders, including one of Bob's colleagues.
My boss.
Or his boss.
Who's getting the...
He
couldn't be here today.
He couldn't be here today. He's receiving one of the Time 100 awards, 100 most influential people. Which, sorry to interrupt you, but
no.
I think it's just it's a great, with all the amazing leaders, they're putting climate and green tech in the Time 100, which is a great accomplishment that we're very proud of.
The well-deserved honor, yes, it's all over our company as well as, I'm sure, the DOE. So they identified a gap in the market at that time. And the gap was there was a lot of great activity that was going on in renewable energy and sustainability. And the financing markets at those times knew how to deal with certain types of risk around infrastructure. And the risks were, you have a large project with investment grade offtake, and banks knew how to step in and finance that. But what they were seeing at that time increasingly were projects that didn't really fit that mold. You had a lot of projects around sustainability, clean energy that looked more like portfolios of smaller distributed projects, situations in which really interesting types of financial supports, regulatory tax incentives, but more complex than what banks were willing to finance. So they really set up Generate Capital as a way to enable the developers and technology providers to scale their businesses who were doing really great things in sustainability, but non-traditional types of project finance. And so today we've continued that tradition, and we predominantly invest in project equity, project debt. We also invest in corporate equity and corporate debt for the companies that are developing, building, and owning these assets. And we will, on the credit side, we will do senior secured as well as subordinated type credit. But it's a real focus, first and foremost, 100% is sustainability focused. And it's really on often projects and opportunities that, other parts of the market are not available to finance.
We'll come back to returns shortly. We'll let Justin talk about
Yes, thank you so much. Thank you to everyone for being here today. So I think Bob and Jeff talked a bit about the projects that they're involved in financing around the energy transition. We do some of that here at RockCreek, but in particular where my team focuses is on the companies themselves. So oftentimes what we see in the energy transition is companies that are seeing tremendous growth, tremendous interest in the projects with the tailwinds of $350 billion and what Jeff and his team are doing. But the companies themselves also need to grow. They need to build like any other company, grow out executive teams, build out systems, and otherwise support the growth that they see. Also, there's a lot of opportunities that we see that aren't related to physical assets related to the energy transition. So software solutions, services, otherwise enabling businesses that are seeing tremendous tailwinds from all of the capital and growth that's now coming in the energy transition, and they need capital to grow. So we invest really across stage. So we do everything from pre-seed, first dollar in to companies, all the way through helping some of the most mature companies in the energy transition expand and grow. As Afsaneh mentioned, I lead our Smart Futures team. That team in particular, we focus on what we call the middle. And so probably everyone's familiar that there are lots of venture funds. At latest count, there's over 330 venture funds investing in new technology. It's a very well-developed part of the market. The large cap on the other end of the market, also very well developed. At latest count, I think there was, I saw over $50 billion raised in Q4 alone of last year to go into basically funds that are $1 billion plus. But what there isn't today is the middle, right? So these are companies that have proven their technology, they've gained commercial traction, they're growing very rapidly, and they need capital to support that. And that's one area in particular that we think there's tremendous opportunity right now that we're focusing on.
Thank you for those introductions. Coming back to you, you've been at the LPO for 10 years, right, at least. It would be great to hear how has that evolved, and particularly, for example, Tesla was one of your early investments. A few people remember that it would not be where it is if it wasn't for that early financing from the LPO. If you could sort of talk about a little bit about the history, but then also how your investments different today. If there are any examples that you could share publicly.
Sure, thank you. Yes, I did join about 12 years ago.
Oh, 12, sorry.
12 years ago at the LPO, and it was right after, I just wanted to be, because it was right after the original sort of main authority for the LPO sunsetted. It was under the American Recovery and Reinvestment Act. We received a significant amount of funding, and there was a sunset of September of 2011 for utilization of all the funds. And I joined slightly after that, and I joined the portfolio management division to manage all of those investments. But we had made a number of investments at that time in green energy. So we did the first utility scale solar PV projects in the United States. Before LPO, there was no projects larger than 50 megawatts. And these were driven by the renewable portfolio standards in the West. So we did a lot of projects in California and Nevada, Arizona, really in the West Coast. We did solar PV, concentrating solar, geothermal, wind, one transmission line. These are all essentially secured by long-term offtake agreements, power purchase agreements. So you have an agreement for 20 years on price and quantity. And that makes for a very convenient financing structure when you have long-term offtake with an investment grade entity. And then we also had, as you mentioned, we were in automotive manufacturing. We provided the first loan to Tesla. So when Tesla, they reached a certain level of growth through venture capital and private equity, they came to us for their first senior debt, which we often see. That's what we often see are startup growth companies that reach a certain stage that come to the LPO for their first debt financing, and they're it's a challenge to close your first major debt financing, and also another challenge to close it with a government entity. So it's a very careful process. But Tesla, we provided a $465 million loan. They launched the Model S. It was very successful. They went to the capital markets. They raised, I think, $2 billion, and they paid us back in full. And we're happy. They're happy. Everyone went their way. And then we had some projects. We've supported the Vogtle nuclear power project in Georgia. So we're providing $12 billion. That's a corporate loan to the owner of Vogtle. So we didn't take a project risk on a nuclear power plant. So in those days, I mean, you sort of add it up, and it was we had we made $32 billion of investments. It was very regionally concentrated. So we were in the West, we were in the Southeast, we were with Ford in the upper Midwest. And then we had a period of low activity under the last administration where not many things happened, but through it, Congress kept funding us. We didn't make a lot of new loans, but we were managing the portfolio, which we've managed to a 3% loss rate on innovative startup new technology. And then fast forward to the Inflation Reduction Act, the IRA, and we received $350 billion of lending authority and a doubling of our program budget to implement the lending authority. Now we have applications in 50 states, and plus some of the territories. We've moved. We're always chasing the innovative technology. So we're not doing solar and geothermal so much anymore. We're doing hydrogen, sustainable aviation fuels, a lot of manufacturing. I'll talk about that in a minute. We're trying to bring the battery supply chain back to the U.S. for both utility battery storage as well as EV batteries. And we're much larger, and have much more broader impact. I think in both phases of the LPO we have been impactful, but I think right now we're much more of a national, covering the whole United States program.
Super interesting. Do you collaborate with universities at all? We happen to have the president of one of the most important universities.
We collaborate. Well, we're certainly open to collaborating with universities. I don't know how you mean.
Innovators in the universities.
Well,
we happen to have a quantum computer.
Well, we have the DOE National Labs. So, we would love to cooperate with them, but we have the resources of all the DOE National Labs who we coordinate with a lot.
Wonderful. Justin, I just heard, aviation fuels, I heard batteries. Are those areas where you feel there could be returns? Because the big question, I think, in the mind of many people here is really, can you get returns by investing in this space?
Yeah, it's a great point. And in a lot of these new and emerging technologies, we see a lot of evolution that's taken place and continues to take place. There are certainly times where we're investing in that technology, and I'd say in those places like in sustainable aviation fuel, which is really an area that's really emerged and grown over the last couple of years in terms of interest. What we see are absolutely tremendous market sizes and total addressable markets that are in the hundreds of billions of dollars. If not sometimes into the trillions of dollars when you start to talk about things like green hydrogen and some of these other fuel types. So the ability to make money in some of those areas, oftentimes it's, even if it's sort of the argument of even if you can capture just a few percentage points of the market, you can do very, very well. So certainly there are interesting opportunities like that. But I'd say also, a different flavor of this that we think is particularly interesting is there are oftentimes in these markets companies that are already making money today. So you mentioned in the battery space, that's a market that I think has grown something like tenfold even in just the last couple of years in terms of the numbers of batteries. And if you look out, that is just expected to continue as EVs and renewable energy and other initiatives to electrify everything roll on. But there's a lot of opportunities that come with that. So we just recently invested in a company, for example, a company called Renewance. They're a business that is focusing on the maintenance, the repair, the optimization of batteries, the commissioning, the decommissioning. Basically, there's a lot of investment at the battery manufacturing side of things, and then there's been some investment in the recycling side of things. What's less developed is everything in the middle, right? These are new markets that are massive, that have grown essentially overnight. And so what we see is an opportunity for companies that can go into that middle and provide kind of these basic picks and shovels type services. And in that case, that's a company that is growing very, very rapidly. I think they tripled in the last year. You can essentially look back a couple of years and see how battery growth has grown, and that's what they track, right? As more batteries are out in the field, there's more need for their services. But it's also profitable. There's no technology that they're dependent on. And so, there are ways that you can, invest in profitable businesses. And, I'll mention also briefly Generate, although I won't talk about it too much. I'll let you do that. But, obviously that's another example of how these technologies that, 10 or 15 years ago maybe were novel or just emerging have now really matured into a place where they can generate a lot of cash and provide a lot of returns to investors.
It's quite interesting, Jeff. When people look at the covers of newspapers, it says, EV demand going down. I mean, the vibe is there was growth in the energy transition area, but now we're kind of slowing down. But then when I talk to you or others who are in the industry, you seem to be making a lot of money in a lot of different ways. And I think something that is on the mind of a lot of chief investment officers and people who are investing really across different areas is there opportunity to make returns? Because everyone remembers getting early, as Justin said, in a climate tech 101 and losing money. So what would you say to those people, and what do you do?
Yeah, so great questions. And so first, I think there is a tremendous opportunity. I think if you sort of take a step back and you look at what's happening across energy, across many of these sectors, we are undergoing a fundamental transformation. Now, when you see headlines that EV sales are down, you're looking at I think last quarter was like 8.5%, and it dropped down by a percentage point. But if you look at the growth of where it had gone just over 18 months, it's very impressive. And then I think some of the headlines you don't get to see are, the amount of capital that's being deployed, the amount of projects coming online in the areas like renewable energy and storage, and all the work that the DOE LPO is doing that's fueling whole new areas around industrial decarbonization. All of these, there are manufacturing, over 200 manufacturing sites that are being funded currently across many of these areas. So there's a lot of this that's occurring in infrastructure. And I think sometimes it's not captured in the headlines in the same way. At Generate, that's what we are focused on. So we focus on infrastructure. Even when we are investing in credit, it's always in and around sustainable infrastructure, and the same if we're investing in companies. And that infrastructure has a profile that you would see in typical infrastructure projects, which, they are cash flowing and, relatively low risk in terms of those projects being built. And we're using generally traditional project finance formulas. But we do generate a lot of cash flow and a lot of profit from those investments and a lot of positive returns. So that is really possible. We tend to focus in areas that are, as I mentioned before, more distributed, in some ways a little bit more emerging. We're not taking technology risk in anything that we do. It's never a question of, is the technology going to work? Is there a product market fit? Will a customer want the services coming off this infrastructure? I think that's more on the sort of venture and growth equity side. We're really looking and saying, here's a technology, here's customers that want to acquire the services, and can we help scale it? Can we take something that maybe is in its earliest stages and help sort of in this bridge to bankability? And the greatest measure of success is after we've done that, if the next wave of projects are being financed by lower cost capital, traditional banks, we feel like we've succeeded.
Give us an example that you can talk about.
Happy to do that. So, I mean, just an easy one is back in 2014, we partnered with probably the leading developer at the time on behind the meter storage. And you think about that, these were lithium ion batteries. The technology had been around forever and was very proven, but they couldn't finance any of the projects. And so we stepped in and we financed portfolios of these projects that have now been deployed, and now it's obviously very commonplace. But back then there was no financing available for that. And within a couple of years of having developed those first portfolios, owning and operating those assets, there was bank financing available for future types of opportunities. So it's kind of that model that we try to follow. And
what sort of return do you target?
Yeah, so on infrastructure assets like that, we will target and deliver mid-teens returns. And again, we look to do that against existing assets that are operating and generating cash flow. And so we feel it's a good risk-adjusted return.
So better than the average infrastructure kind of.
Yeah, I'd probably giving you.
Or the same.
It depends on different segments, and that's probably also maybe less reflective in a interest rate environment that we're in now. I think our return hurdles have gone up from there, but we're generally taking risks to take newer business models, existing technologies, and figure out how to scale that. Another interesting one I could talk about is we worked with a company that was a leader in actually providing batteries for forklifts for distribution centers. When you think about that, you're like, how big of a market is that? And it's actually pretty huge if you think about Amazon, Walmart, US Postal Service. And the challenge they had was they were using lead acid batteries. These batteries took up about 20% of the available floor space in the distribution centers to charge and recharge. And they burned through them really quickly, and they had to be disposed of. So we approached them with a solution around fuel cells, and we're able to deploy these fuel cells and have helped them grow and scale. And now, again, it's a commonplace technology in any distribution center you go in. You'll see forklifts are being run on hydrogen-backed fuel cells. And the financing costs have come way down. So that's how we think about it.
Can you talk about any companies that are recent in the portfolio that you can talk about and you feel is sort of a new technology that they will be investing in 10 years?
Sure, I'd be happy to talk about a couple examples. And as I mentioned before, we're involved in bringing the battery supply chain back to the United States. From that, we're doing some critical minerals projects. So we're doing 2 lithium projects in Nevada. We're doing a graphite project in Louisiana. We can't finance the mining, we can finance the processing. And so we're financing the processing of those materials. Then we're also financing, on the other end of the scale, a large scale battery production plant. So we have a joint venture between LG Energy and GM called Ultium Cells for a $2.5 billion battery plant in, I think, Kentucky and Ohio. And then we have another joint venture with Ford and SK that's a $9.2 billion loan to produce batteries for EVs. Then in the middle, the interesting part, I think, is we're doing two startup companies are doing battery recycling. So and this is all public. This is on our website. Redwood Materials is a startup company, actually started by the former chief technology officer of Tesla, who then started battery recycling, and they're taking post-consumer batteries from Walmart, from Home Depot, taking them all to this big facility in Nevada outside of Reno. And then they process them and recycle them, and then they're making copper foil and cathode active material for inputs to new EV batteries. And so I think that's going to be a growing area. And the other one is Li-Cycle, which is a battery processing facility in upstate New York, which has a slightly different business model, but is also taking post-consumer batteries, recycling to, again, bring these technologies to the US. And then kind of on the other end of the scale, we're also doing kind of a pure technology play is the virtual power plants. So we provided a loan last fall to a company called Sonova out of Texas to do virtual power plants in 48 states. And what they do is they aggregate loads. They take they aggregate rooftop solar and home battery storage, and then they can provide demand response to utilities by aggregating consumer or homeowner storage. And they have a requirement to do 20% of their projects in Puerto Rico, which is coincidentally one of the highest concentrations of rooftop solar and battery storage. So that's a couple of areas I'd say. I mean, really, it's kind of manufacturing on the one end, and then on the other end, technology.
Super interesting. And I think as you're talking about all the different areas, where you're going in is take that sort of risk in the early stage, whether it's in the kind of financing or the kind of company.
Yes, I mean we're organized specifically to take first of a kind technology risk and scale up risk. So certainly,
so you can fail.
We can fail. We have not. We have. We. I mean, just to be clear, I mean, out of the $34 billion, we've lost $1 billion, and Congress appropriated $4.5 billion. So we've sent back $3.5 billion to Congress. I don't know what other loan program does that, but anyway, we've had failed, and in some certain circumstances. But I think what my opinion is, what LPO is very good at is de-risking technology from the point of view of the senior lender. So we're very good with our engineers in having the first line built with equity, proving the output, then putting in the debt. We're very good at de-risking the technology. We have a lot of single B, double B companies. We can't take those and make them magically investment grade, but we can apply our principles to have a reasonable assurance that we're going to get the debt repaid.
So Steve Case talks about rise of the rest, as you were talking about, working in Arizona or working in Louisiana or parts of New York State. It sounds like you're looking at that rise of the rest in the sense that the investments in innovation in this area is sort of going all over. The big question, I think, to all three of you is what the previous panel talked about, but comes up in this conversation about things related to climate broadly, which is that if in November President Trump does get elected, what happens? Does this stop? Do you stop doing what you're doing? Or is there a different scenario?
Am I up first?
Go ahead.
I am pragmatically optimistic. I think that we are, as I mentioned, we're doing manufacturing projects. Our latest loan, we closed a loan just a few days ago, I think within the last week, to do wire harness manufacturing for EVs in Georgetown, Texas. 1,200 jobs, $362 million loan. There's the headlines, and then there is, in my view, the reality that all the people in Congress like to have infrastructure projects in their states. They like to have jobs. We're building a track record of success. I think that we have a path to continue what we're doing. And as I mentioned, even before, when the last administration directly through OMB wanted to shut us down, Congress kept funding us. And so I think that we have a path to continue what we're doing. And the IRA, our funding does sunset in 2026 for Title 17 and 2028 for ATVM and the Tribal Energy Program. But I really think that we will build the track record to extend the program beyond that.
Thank you.
Yeah, I was going to use the term cautiously optimistic. So I think a few things. I think the Financial Times just did an analysis recently that showed that 80% of the dollars being deployed, both from the loan program office as well as the equity, were being deployed in red states. I think to echo Bob's point. I also think in the event that there are some things that get rolled back, which I'll talk about in a second, I think a lot of the states are committed to step up and even be more aggressive. So these things tend to be, I think, generally not as bad as we fear. I would expect certain things to be rolled back. So I think there are provisions in the IRA. I think some of the labor provisions, energy communities, some of the EV programs are probably targeted. I would worry about a little bit of Treasury's pace at implementation and or not. And some executive orders might be some things that could be done by executive order. I think, though, generally rolling something back like that is really hard once it's in place. particularly when it has tax implications. It's really hard to get that done. And I think if you think about the likely congressional outcomes, I mean, as I think the last panel referenced, I'm not an expert, but just what I read, it's likely to still be very close no matter how that plays out. And that means it's going to be difficult to get legislative large changes, I think, to these programs. I think there's also certain areas like biofuels, carbon capture, that are also popular across a really wide spectrum and that are unlikely to be touched. So I think all in all, I think the fear is likely to be worse than the reality, and I would expect there to be some changes, but not as drastic as I think everybody may fear.
Yeah, and I would echo everything said. The other part I would say about the way we invest specifically is we very intentionally invest at the intersection of what is good for the energy transition, but also just as importantly, what's good for business. So we, in everything we do, you could remove the energy transition, climate impact, benefit, and the investment should still stand on its own from a payback ROI standpoint. It's actually one of the criteria for everything we invest in. There needs to be, for us to invest in the company, there needs to be a positive ROI to their customer. And so, should there be a reduction in the tailwind that sits behind that, in some upside scenario, it may reduce what that looks like. But across the board, the companies that we invest in, we would expect will still see growth, will still see profit, because the solutions they're providing just become smart business practice to their customer.
Maybe one just thing to add, which I just thought of. I agree with all that. I also think if you look at the first Trump administration as a guide, what you saw was still tremendous growth in all of these areas of sustainability. Many of these segments had their best run actually, to date, during the Trump first administration. And so I think there's a lot of momentum from, again, targets set by governments, by corporations, and a lot of elements other than just, U.S. federal policy. Not to discount that.
By the way, I think since we're sitting in Washington, I asked the question, but I very much agree with the three of you, but also talking to friends who are in Texas and elsewhere, I think they all are actually, even not cautiously, they think these things will go on. If they make sense, they will go on. If they don't make sense, they won't. So it's the economics of the investment. But also in the previous meeting like this that we had, Britt Harris, we had invited to the meeting, and we were having this kind of conversation. And Britt was invited because he's in Texas. He was at that point the chief investment officer and the CEO of UTIMCO, which is the University of Texas. And his board is very much the oil and gas companies in Texas. And he's very outspoken person. So there was a certain assumption of what he might say in this kind of conversation. And Britt came to the conversation. He messed up the whole conversation by saying the energy transition is the biggest opportunity of our lifetimes. He continues to teach that at Texas A&M, and he teaches a course which is very famous and the most popular course at UT, but also to practice that, and had a huge meeting in Texas where all of the politicians, it was very interesting to be in the room where people talked openly, where they were talking, don't bother us about oil and gas, we will continue doing that, but our new money is going to what you all have been talking about. So it was very different than the newspaper headlines that we read. But I have a question for you, related but more broad. Let's go ahead.
Oh, I was just going to say, I agree with that 100%. I also think some of the things that Bob talked about where the LPO has led on investments, these are not short-term investments. When there's a $6 billion loan facility out to build, manufacturing, there's also a commitment from the sponsors and the companies who are going to operate this infrastructure. It's very difficult for them to walk away from it. And then the last thing I'll throw out there, and there's probably everybody in this room more qualified than me, but I was over in Europe a couple weeks ago, and it was a really interesting conference on infrastructure. And I was struck about how a lot of the speakers and people I were interacting with were talking about sort of the dynamics, at least in Europe. And in Europe, there's now a big push for investing in defense. And there's been an underinvestment in a long period of time. And they think that some of this may be, coming from other infrastructure investments. And so thinking about the global aspect of this, right now the U.S. is benefiting from a lot of the tailwinds. And I think that will continue even through a Trump administration.
Super interesting. But also, the other news that came out in the last couple of weeks was EPA's $27 billion program that is supposed to, among other things, continue to do some of the things you all talked about, but also looking at community solar, let's say, and distributed energy and community solar for low-income and tribal communities. Is there a way to do those investments and make a ton of money for universities, endowments, pension plans, or not?
I'm happy to. Yeah. So so community solar is a program that is set up by individual states, and it enables the oversimplified explanation, but to basically build solar at sort of utility scale economics, almost like a solar garden that's shared among many different people, and then sell power at retail rates. And this enables a lot of people that can't have rooftop solar to participate in renewable energy programs. They may live in an apartment building, they may have a roof that's not appropriate. And this program opens up the access to a lot of people who couldn't either afford or don't have a rooftop for residential solar. The programs have been very popular. States like New York and Illinois that have had established programs have grown very quickly. We've been a big investor in this area, and believe very much in these programs, and they're very profitable. So while they're smaller projects, typically about 5 megawatts, or you might have a couple of hundred people sharing the solar on that, as opposed to a utility scale project that would be much bigger. The programs give individual customers a discount on their energy bill, but because of this ability to build a utility scale and still sell close to retail rates, they're very profitable projects.
Justin?
Yeah, so I think that's right. I think, one of the things we see is that, just sticking with the solar theme, solar at this point makes sense in quite a large percentage of the country. I think the last number I saw was something like 2/3 of the country. It's economically competitive with traditional power. But what we also see is only a few percentage points of actual power comes from solar today. And so, when we look at that discrepancy, it's not a technology discrepancy. It's a question of, how do you get solar to be in markets where, where it hasn't traditionally played. So the first place solar was deployed was people that had a lot of cash that could outright buy these systems, and they own their roof and could do what they wanted on it, and they could do that. Fortunately, someone came along and revolutionized that, and addressed how payments could work, and came up with the concept of how you could basically get loans to cover some of these costs. And then that's evolved and evolved and evolved, and community solar is one of those models. Things like one of the holdbacks, though, still is capital, right? So capital is still disproportionately expensive for energy transition because a lot of these solutions are newer. We've heard about different ways people are addressing that, but this $27 billion is also helping lower that barrier so that projects can succeed without these incredibly outsized financing costs.
I think we could go on for a while, but I see that the next panel has been waiting patiently for us. So I'm going to thank you all and look forward to our next conversation.